Hey everyone, welcome back to Corporate Decoder, the place where we decode the confusing world of corporate finance, and boy do we have a doozy for you today. Get ready to dive into Forum Energy Technologies Inc.'s latest financial report where even the numbers seem to be playing hide and seek. Before we start, if you appreciate getting straight insights from these dense filings, make sure you are subscribed. We also have a Discord community linked in the description below where we discuss all sorts of financial findings. Make sure to drop by scroll commission file number 001-35504. Scroll, this is Forum Energy Technologies, or FET, filing their annual report for the year 2025. Think of it as their yearly financial checkup, and like any checkup, it can reveal some interesting health indicators. We see total revenue at $791.5 million. That is a drop of about 3.1% from the previous year. Now, a 3% dip might not sound like much, but in the business world, that can translate to losing a significant chunk of business. It's like a store losing one out of every 30 customers they had last year. For FET, this dip seems to be driven by a slowdown in global drilling and completion activities, as well as some tariff issues impacting their valve products. Their drilling and completion segment, which makes up about 60% of their business, actually saw a slight increase in revenue, up by 1.4% to $477.2 million. This growth is thanks to more projects involving their remotely operated vehicles, or ROVs, and increased sales of coiled line pipe. But this good news is somewhat dampened by a general decrease in worldwide drilling and completion activity. It's like a popular product in a store doing well, but the overall store traffic is down. On the flip side, their artificial lift and downhole segment saw a more noticeable decrease in revenue by 8.9%, bringing in $314.8 million. This segment is hit by lower sales of sand control products and also those tariff impacts on valve sales. They did see some positive movement with higher sales of casing equipment, but it wasn't enough to offset the other declines. Now let's look at how much profit each segment is actually making. Segment operating income for the entire company was $19.1 million, a significant drop from $35.7 million the year before. That is a nearly 50% decrease in profit. Their operating margin also slid from 4.4% to 2.4%. This means for every dollar of sales, they're making much less profit than before. The drilling and completion segment, in particular, saw its operating income drop by 27.8%. And then there are these big hits that are not part of the day-to-day operating profit. In 2024, they took a massive charge of $119.1 million for the impairment of intangible assets. This is like a company admitting that some of its past investments or acquisitions are now worth a lot less than they thought. For 2025, they reported an impairment of $4.3 million for property and equipment and lease assets, which is related to their decision to consolidate facilities and stop making some products. Putting it all together for income before taxes, they actually posted a profit of $16.6 million in 2025. This is a huge improvement from a loss of $128.4 million in 2024. This swing is largely due to that massive impairment charge they took in 2024. Without it, their core operations were still struggling. So after all the costs and taxes, the company reported a net loss of $9.7 million for 2025. That's much better than the $135.3 million loss in 2024, but still a loss nonetheless. It means that even with the improvements, the company as a whole is still spending more than it's earning. One of the interesting things that comes up in these reports is goodwill. It is an accounting term that represents the extra value paid for an acquired company over and above its identifiable net assets. For FET, they have $64.7 million in goodwill related to their downhole reporting unit. They did their annual check for any losses in value, and thankfully, it looks like the value held steady. This is good news, as a goodwill impairment would mean they overpaid for that acquisition. They also have significant intangible assets like customer relationships, patents, and trade names, totaling about $93.6 million. A big chunk of this, $119.1 million, was written off in 2024 because the coiled tubing product line faced a lot of challenges, including tariffs and rising steel prices. This write-off really highlights the tough market conditions they've been navigating. Let's talk about their debt. As of the end of 2025, they had about $135.9 million in long-term debt. This is down from over $188 million the year before. They made some smart moves, paying down their credit facility and their seller term loan, and issued $100 million in senior secured bonds maturing in 2029. This shows they are actively managing their debt structure, which is crucial for financial stability. It is always important to see if a company is generating cash from its core business. In 2025, they brought in $70.4 million from operations. This is down from $92.2 million in 2024. While they are generating cash, the decrease suggests their core operations are bringing in less cash than before, even if their reported net loss improved due to other factors. Their accounts receivable, meaning the money owed to them by customers, is $142.4 million. This is a decrease from the previous year and a good sign that they are collecting payments effectively. Now, inventories, that's the stuff they have on hand to sell, is sitting at $239.4 million. This is also down from the prior year. They had to write down about $19.7 million worth of inventory in 2025, likely because some of it is obsolete or slow moving. This tells us they might have over-ordered or that their product demand predictions were a bit off. Looking at their corporate expenses, selling general and administrative costs, which are things like salaries, marketing, and office expenses that aren't directly tied to making a product, were $199.9 million. This is down from $219.3 million the year before, which is a positive sign as they are controlling their overhead. Let's shift gears to the risks. FET operates in a highly competitive industry heavily tied to the oil and gas sector. This means their success is directly linked to the unpredictable prices of oil and natural gas. If prices drop, their customers cut back on spending, hitting FET's revenues hard. They also face risks from consolidation in the industry, potential regulations on hydraulic fracturing, and even climate change initiatives that could reduce demand for their traditional products. They also have a cybersecurity program in place. The board's audit committee oversees it, and management receives regular updates. They have internal teams and external consultants working to protect their systems, which is crucial in today's digital world. While they haven't experienced any material cybersecurity threats, they do acknowledge the constant evolution of threats and acknowledge that no system is completely foolproof. In terms of legal matters, they mention that they are involved in various lawsuits, but they don't believe any of them will have a major impact. They do have some asbestos-related litigation affecting one subsidiary, for which they have set aside a small reserve. They also mention a patent dispute with Tenaris that they seem to have won, though Tenaris has appealed. As of the end of 2025, FET had around 1,700 employees spread across the US, UK, Germany, and Canada. They seem to have good relationships with their employees, and they are not party to many collective bargaining agreements. On the stock front, their common stock trades on the New York Stock Exchange under the symbol FET. They have a program to repurchase their own stock, and in 2025 they bought back about 1.4 million shares for $34.3 million. This can be a way for a company to return value to shareholders when they believe their stock is undervalued. Share buybacks can also reduce the number of outstanding shares, potentially boosting earnings per share. Looking at the market conditions, oil prices saw a decline in 2025, with Brent crude averaging around $63 per barrel in December. Natural gas prices, however, strengthened. The number of active drilling rigs globally also decreased, which directly impacts FET's business. When we look at the overall financial picture, the consolidated statements of comprehensive loss reveal the bottom line. The net loss of $9.7 million in 2025 is a significant improvement from the $135.3 million loss in 2024. This improvement, however, is heavily masked by large one-time charges in the prior year, like the $19.1 million impairment of intangible assets. The consolidated balance sheets show us a snapshot of the company's assets, liabilities, and equity. Total assets are $752.5 million, down from $816 million the previous year. This overall decrease in assets is partly due to managing down inventory and accounts receivable. The cash flow statements are crucial. As mentioned, operating cash flow decreased to $70.4 million from $92.2 million. Investing activities saw a positive cash inflow of $9.6 million in 2025, mainly from selling assets through sale, leaseback transactions, which is a way to raise cash by selling a property and then leasing it back. Financing activities used $91.6 million, largely for paying down debt and repurchasing stock. The notes to the consolidated financial statements provide much deeper detail. For example, under revenue recognition, they explain how they account for long-term contracts, measuring progress based on costs incurred or milestones achieved. They also detail their inventory valuation methods and the significant reserves they set aside for obsolete stock. Under goodwill and intangible assets, they provide a detailed breakdown of how goodwill is tested for impairment, and how intangible assets like customer relationships and patents are amortized and tested for value reduction. The debt note is particularly informative. It lays out the terms of their 2029 bonds, their credit facility, and other debts. It's clear they have been actively refinancing and paying down debt to improve their financial standing. The leases note shows their significant commitment to leased facilities and equipment, with operating lease assets and liabilities listed separately. They also report on sale, leaseback transactions, which were a source of cash and gain in 2025. The income tax note details their tax expenses and the complex calculations involved, especially with international operations and deferred tax assets. They highlight a valuation allowance of over $267 million, which is an amount they do not expect to realize as a tax benefit. This section covers potential future obligations like lawsuits and lease commitments. Their asbestos litigation reserve is small, and they believe most claims are covered by insurance or fall under successor liability exceptions. Finally, the business segment section breaks down revenues and operating income by their two main divisions, drilling and completions and artificial lift and downhole. This segregation helps understand where the company makes its money and where its profits or losses come from. So, what's the big picture here? Forum Energy Technologies is in a challenging industry, heavily reliant on the volatile oil and gas market. While their reported net loss improved in 2025, it was largely due to accounting adjustments and not a sudden surge in operational profitability. They are actively managing their debt and have some promising product lines, but the overall market conditions continue to pressure their revenues and margins. They are also exposed to significant risks from commodity price swings, competition, and regulatory changes. The company seems to be trying to adapt by focusing on efficiency and products that help customers lower emissions, as well as exploring renewable energy applications, but it's a slow transition. Their ability to generate consistent operating cash flow and manage their inventory effectively will be key to their future success. Alright, that is our breakdown of Forum Energy Technologies' latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.